Ensuring that we confirm their Australian tax residency at the first step is the essential step in us doing our work. Hi, Mark here from Worldwide Accountancy. Here today to talk about a crucial topic when it comes to your Australian taxes, and that is your Australian tax residency status and the importance of ascertaining it correctly. The thing is, with most Australian taxpayers, they don't even consider their Australian tax residency, and that's because they live in Australia, they work in Australia, and they spend all their time in Australia. Whereas a lot of you may not. So here, I'm here today to talk about how important it is to ascertain it correctly and provide you examples on the difference. In my countless conversations with clients, and no situation of theirs is ever the same, ensuring that we confirm their Australian tax residency at the first step is the essential step in us doing our work. The issue with these tax residency rules at the moment is that they're complex. And if correctly assessed, as you'll see later, you may be liable for thousands, if not tens of thousands extra in tax and potentially interest and penalties from the ATO. The main tax residency statuses are tax resident, non-resident, temporary tax resident, and working holiday maker. So determining your residency status dictates the income that is actually taxed in Australia. For example, as an Australian tax resident, you must declare and pay tax on your worldwide income. So effectively, all the income you've earned everywhere. Whereas as a non-resident for tax purposes in Australia, you are only obliged to declare your Australian sourced income. For example, Australian rental income. The tax rates applied to that income also differ based on your tax residency status. So a non-resident must pay tax from the first dollar at 32.5%, whereas an Australian tax resident pays tax at a slightly different rate, with the first $18,000 being tax-free. And there are certain capital gains tax considerations different between tax residency and non-residency. For example, an Australian tax resident is unable to access the main residence exemption that tax residents can. And one thing to note, and there's also a few other different considerations like your deemed disposals, Medicare status, there's ensuring you don't pay double tax, and a few others here. And so one thing we must note is your tax residency status is independently determined from citizenship or visa rights. And so the right way to determine your tax residency status is by looking at your own personal, unique circumstances. So anyway, we have some examples here that would provide you some detail about how important it is to ascertain your Australian tax residency correctly. We have Natalie here. So Natalie is an Australian living in Dubai, working as a doctor there. In this case, she's an Australian tax resident. So we must include her worldwide income. In this scenario, she's earned $250K working as a doctor in Dubai, $10,000 working from dividends from US shares. Then she's got some Australian income, $20,000 of Australian share sales and $5,000 of Australian rental income. And so that's a total of 285,000 Australian dollars she must declare on her Australian tax return. And the tax payable on that $285,000 at tax residency rates is $104,000 with an average tax rate of just over 36%. Whereas if we compared Natalie being a non-resident for tax purposes, then she must only include her Australian sourced income on her Australian tax return. And so in this case, it's only $25,000 of income she must declare, and the tax on $25,000 is just over $8,000 at an average tax rate at 32.5%. And so as you can see, there's quite a significant difference between the classification of Natalie as a resident to being a non-resident, almost a $90,000 difference in tax payable. Next example, we've got Alex here. So Alex is an Australian non-resident living in Singapore. Alex has a main residence in Melbourne, which he just sold, that was rented for the last few years. So since the main residence exemption and also the 50% capital gains tax discount are no longer available for non-residents, Alex must pay the full tax on that capital gain. So if we look at this scenario, the cost base of $500,000 and capital proceeds of $800,000, that's a capital gain of $300,000. And so if Alex was a resident, then he would not pay any tax on that $300,000 under the main residence exemption. However, as a non-resident, he must pay tax on that one. And on that $300,000 gain, that is taxed at $115,000 with an average tax rate of just over 38%. That is quite the difference between residency and non-residency again. These examples are here just to demonstrate the difference and significance of your Australian tax residency. So please reach out if you have any questions or if you'd like to chat further about your Australian tax residency status. We also have a research tool on our website, which we provide to help you shed some light on your Australian tax residency status. You'll find that link below. And as every other YouTuber says, please like and please subscribe, because this really genuinely helps us get our message across to more people like you. And we want to continue providing useful information. So thank you so much and have a wonderful day.